After retiring, your TSP account can be a crucial source of income to complement your pension, Social Security, and other streams of money. But one of the most puzzling questions for retirees is how to effectively withdraw funds from their Thrift Savings Plan. This video is part of a series of videos where I'm breaking down the different withdrawal options that are available with the TSP. The first video focused on the TSP annuity, and in this one, I'm going to cover TSP installments. Specifically, I'm going to review the two types of installments that are available to you. I'll point out the key features and components of each one. I'll also discuss everyone's least favorite topic of taxes and how they may impact both options. And lastly, I'm going to highlight the critical advantages and disadvantages of the installment plan. But before we tackle those different topics, welcome to the Money Briefing. My name is Jarrell Harvey, and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. TSP installments is a popular way to withdraw money directly from the TSP in retirement. Installments are often called automatic withdrawals because once they are established, payments will continue until you stop them or until your account balance falls to zero. Installments can be scheduled up to 6 months in advance, and you can choose to receive payments on a monthly, quarterly, or annual basis. There are two ways to set up installment payments. One way is through a fixed dollar amount, and the other way is based on your life expectancy. Before we discuss the key differences between the two options, let's first focus on what they have in common. When you choose to take installment payments, your money stays within the TSP and all your cash remains fully invested based on your fund allocation. The minimum duration of any installment plan is at least 1 year, but after that initial year, you can stop your installment payments at any time. With your installments, you can choose to make withdrawals from your traditional account only, from your Roth account only, or you can take distributions from both accounts on a proportional basis. If one of your accounts runs out of money, payments will automatically switch to the other account that has remaining funds. Installment payments are made on the 15th of the month or on the next business day if the 15th falls on the weekend or on a holiday. Let's now discuss how the fixed dollar amount works. With this option, you can choose how much you want to get in each payment, as long as the amount is at least $25. This choice provides a lot of flexibility because at any time, you can change the amount, frequency, or payment source of your installment. When you set up a fixed installment plan, the TSP will calculate the expected duration of your payments based on your total account balance, the payment amount that you choose, and an assumed earnings rate. Depending on how long your payments are expected to last, there are two different tax rules that may apply. If your payments are expected to last less than 10 years, 20% of your withdrawal amount will be withheld by the TSP. You can have more taxes taken out if necessary, but you cannot waive or decrease the taxes below the 20% threshold. However, one way to reduce or eliminate your taxable income under this scenario is to have the TSP directly transfer your installment payments to an IRA or eligible company plan. The other exception to this rule involves payments that satisfy your RMD requirements. Only 10% will be withheld for any payment that goes toward meeting your required minimum distribution. You can also reduce RMD tax withholdings down to 0%, but you cannot transfer these payments to an IRA or eligible company plan. The other tax category is for payments that are expected to last 10 years or more. For these payments, federal taxes will be withheld as if you're single with 0 exemptions. It's important to note that this tax withholding started in 2023. For individuals who have installment plans that started before 2023, your default withholding is set as if you're married with 3 dependents. If you want a different withholding, than the default setting, you can change your tax percentage, or you can have no taxes withheld at all. Similar to RMD payments, installments lasting more than 10 years cannot be rolled over to an IRA or a company plan. I'm now going to pivot and talk about the life expectancy payout option. With this choice, the TSP will calculate your installments based on IRS life expectancy tables. Your initial payment amount will be based on your age and your account balance at the time of your first installment. Life expectancy payment amounts are calculated using your entire account balance, even if you choose to take your distributions from your traditional account first or from your Roth account first. Every January, the TSP will recalculate your installment amount. After the initial year, the calculation will be based on your age and your account balance at the end of the previous year. For example, your 2025 installment payment will be based on your account balance as of December 31st, 2024. Whenever you take additional distributions from your TSP or add money to your TSP from a rollover, the Thrift Savings Plan will recalculate your payment amount. For tax purposes, life expectancy payments are treated just like installment payments that are expected to last 10 years or more, which means your tax withholdings will be as if you're single with zero exemptions, unless you change it to a different option. An added benefit of receiving installment payments based on life expectancy is the exception to the 10% early withdrawal penalty. So, if you're taking life expectancy withdrawals under the age of 59 and a half, this penalty would be waived. However, this tax penalty can be applied retroactively if within 5 years of beginning your installments or before you reach age 59 and a half, you stop your life expectancy installments, you switch your payments to a fixed dollar amount, or you take a distribution from your TSP account in addition to your regular life expectancy payments. Doing any of those things in that period will make you liable for the tax penalty on the installment payments that you previously received. If you're uncertain about going with the fixed dollar amount or the life expectancy payment, you can model potential installment strategies by logging into your personal account on the TSP website. Bear in mind that any investment gains or losses could increase or decrease either the amount of your life expectancy payments or the duration of your fixed dollar payments. The TSP website, as well as a thrift line, can also be helpful with stopping or making changes to your installments. Some administrative changes can be done without stopping your installments, but other requests may require you to stop your payments and reapply under a new installment plan, and you may have to wait at least 30 days between making new distribution requests. Overall, TSP installments can be very attractive because you can collect recurring payments while maintaining control over your TSP savings, and your money can remain fully invested. Another advantage is the ability to stop or change your installment payments. A drawback of this option is that the payments are not guaranteed, so you could potentially outlive your savings. If you received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you're interested in seeing how we help our clients at Fedway Financial get the most out of their money and federal benefits, visit our website at www.fedwayfinancial.com, or you can schedule a free consultation by clicking on the meeting link in the video description. Thank you for watching, and we'll see you on the next Money Briefing.